Today I want to share with you 3 things about superannuation which I think are pretty amazing, but unfortunately not a lot of people know about. Now this is going to be just a real high level look at these strategies, so if you think that it is relevant for you or your situation, then I would highly recommend that you do some additional research and get professional advice if you need it. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are taking a closer look at 3 aspects of superannuation which I think are pretty amazing. Firstly, superannuation is not an investment. Now that may sound silly to say, but it's true. Superannuation isn't an investment, it is a structure. Just like a company is a structure or a trust is a structure. The assets you hold inside your superannuation, they are your investments. And it's important to make this distinction because when you start to understand superannuation as a structure, you can really start to maximize some of its potential. For instance, a lot of people think that superannuation is a bad investment because if you go through a lot of super funds, they will just give you a handful of investment options or profiles, none of which you really understand what they're actually investing in. They just give you this little asset allocation pie chart. But when you start to understand superannuation as a structure, you come to realize that you can just about invest in anything you like through your super. So this includes the obvious such as shares, term deposits, cash, bonds, as well as the not so obvious asset classes, including direct property, so like an investment property, maybe crypto. You can even invest in artwork through your superannuation, should you be so inclined. But by starting to see superannuation as a structure and getting the right structure to be able to purchase the assets that you want to hold inside your superannuation, that's when you're going to start to feel a lot more comfortable with it, and that's also when you're going to start to utilize some of its potential, such as tax planning. This brings me on to my second fun fact about superannuation, and that is super is the most tax effective structure that you have available in order to invest because it gives you a tax deduction for investing for yourself. Now, let me give you an example. Let's say that you decide to buy $5,000 worth of stock in XYZ because you think that it has great potential to grow in the future. Now, your next decision is, do you buy those shares in your personal name or do you buy those shares through your superannuation fund? If you buy the shares in your personal name, it's pretty simple. You take your $5,000, you put it into an online broker account, and you purchase the shares in your own name. Now, any future income and capital gain will get taxed at your marginal tax rate. Option B is where you buy the shares through your superannuation. And now in order to do this, you would take your $5,000, contribute it to superannuation as a personal deductible contribution, which means that you can claim a tax deduction for making the contribution, and purchase the shares in your super fund where any future income or capital gain is going to get taxed at the superannuation rate, which is a maximum of 15%. So that's a pretty good outcome. You've just purchased your shares in XYZ in a very low tax environment, and you've got a tax deduction for doing so. But there are a number of things to consider before you actually go ahead and do something like this. So for instance, the contribution is going to be classified as a concessional contribution and receive a 15% tax rate. If you're a high income earner earning over $250,000, that tax rate could increase to 30% under Division 293 tax. Also, there's contribution cap limits on how much you can contribute to your superannuation every year, so you need to make sure you're working within those cap limits. And of course, once the money is in superannuation, it's generally stuck in there until you meet a condition of release. So it's not all rosy. There's a lot of things that you would need to consider before doing a strategy like this, but provided you understand the rules and you're willing to work within those rules, then superannuation can be a very tax effective environment to invest through. My third amazing fact about superannuation, also related to tax, is that super gives you the ability to pay no tax on any accrued capital gains. So for anyone that doesn't know, capital gains tax is the tax you get charged when you sell an asset for more than what you paid for it. So for example, if you purchase those shares in XYZ for $5,000, you hold them for 10 years, and in 10 years time you sell them for $20,000, well, you've made a $15,000 capital gain on that. And the ATO basically wants their chunk of that profit, which is capital gains tax. In super, you have the ability to pay no capital gains tax by utilizing what's called an account-based pension. The way it works is that when you're contributing to your superannuation, you're in what's called accumulation phase. An accumulation phase is a 15% tax entity. Then, when you reach preservation age and have retired or reach age 65, you can convert your superannuation into what's called an account-based pension. And an account-based pension is a 0% tax entity. So that means you don't pay any tax on any income generated in the fund, any capital gain generated within the fund, and any withdrawal is 100% tax-free as well. Going back to the ability to pay no tax on accrued capital gains, if you purchase an asset in accumulation phase, you then transition that asset into pension phase, you can sell it down in pension phase and eliminate all accrued capital gains. So for instance, in our example of XYZ shares, if you purchase $5,000 worth of XYZ shares in accumulation phase, you later on transfer that to accumulation phase, and let's say they're worth $20,000, you can mitigate all of that $15,000 gain you made. Or you can think more large scale about it. So maybe you buy a $500,000 investment property in accumulation phase. Later on in life, you transfer that to a account-based pension and you sell that property in the account-based pension for say $800,000. Well, then you've made a $300,000 capital gain that's 100% tax-free. So that's my 3 amazing facts about superannuation. Now, as I said at the start of this video, this is very high level. There's a lot to consider before doing or utilizing any of these strategies. So if you were considering doing it, then do some more research or reach out and get professional financial advice. But if you found this video helpful or useful or even interesting, then please give it a thumbs up and I will see you guys in the next one.